Okay, thank you very much for attending. Good afternoon. Welcome to our webinar covering historical downturns and recoveries. We appreciate you joining us, and I hope this time together will be very beneficial. I'd like to start today by saying I hope you and your families are safe and in good health. Recent times can be very uncertain and quite frankly scary. I pray that each of you stay safe and your means of income are protected. My name is George Abood, CEO of Smart Group Houston and Exponent. Smart Group Houston is a full-service, holistic financial planning firm that partners with our clients in providing clarity for their financial independence, while Exponent is a business advisory firm designed to help privately held business owners build prosperity through every stage of their journey. Many of you know, as of Friday, April 3rd, the S&P declined about almost 23%. And at times, it was down 30%, according to Morningstar. We'll be using Morningstar's data for today's presentation, and I hope it is informative. We know that volatility has been high as fears of uncertainty is taking its toll. I'm sure many of you are wondering where the market will hit bottom. Is the market at a bottom currently, or will it continue to decline? If we gave you that answer to the question now, it would be a very short webinar. The truth is that we don't know. But the information we covered today may be helpful while you navigate through today's markets and build a strategy for tomorrow. In today's webinar, we can see how this recent downturn may compare to historic downturns. In addition, we will observe historical market recoveries and how expanding one's investment timeline, maintaining a well-diversified portfolio, as well as the importance of staying invested after the market has declined, has historically impacted investor performance. We encourage you to submit questions during this webinar under the chat and leave your email, as in the best interest of time, your time, and our compliance regulations, we'll be happy to reach out to you personally after the webinar to discuss any questions, concerns, or issues you may have. Also, we'd like to remember a few things before we begin. Please remember that past performance, which we're taking a look at today, does not necessarily guarantee future performance, and returns and principals invested in the stocks are not guaranteed. Each investor may have different objectives, different resources, timelines, and risk tolerances. Not any one strategy or investment would be appropriate for everybody. Concepts that we will cover today will include investment time horizon, diversification, dollar cost averaging. While these may reduce risk, they may not eliminate risk. Okay, we'll begin today by looking at the last 8 market downturns in the past 47 years and the expansion that follows. Please notice that the stock market moves in cycles with periods of contraction followed by periods of expansion. The regions shaded in orange highlights a contraction phase of the stock market cycle, and the green regions that follow show an expansion phase. A contraction is defined by a period when the stock market value declines from its peak by 10% or more. These declines seem to happen at random and last for varying time periods. Expansion measures the recovery of the index from the bottom of the contraction to its previous peak and the subsequent performance of the index until it reaches the next peak level before another 10% decline. The last contraction was associated with the trade war in China and rising interest rates, began in October 2018 and ended in December 2018, the fourth quarter of 2018. The stock market recovered from its crisis in April of 2019. While some periods of decline may have been severe, the market overall has grown over time, as you can see from this chart. For instance, the stock market fell by 14.7% from its peak in May of 1990 through October 90. But then look, it grew 355% from November 1990 to its next peak in June 98. No one can predict market declines with certainty, and investors should have a long-term investment horizon to allow their investments to grow over time. Please remember that returns and principles here are not guaranteed, although it is very interesting to look at this historically. I really like this chart. It really tells a lot. Here we're observing the risk of the stock market loss over time. We'll be looking at three different investment scenarios based on the top at a 1-year time period, in the middle at a 5-year annualized return time period, and in the middle at 15-year annualized time periods. So that the top, the first scenario, shows that each year is a certain return. And it's the history of the market from 1926 to 2019. With a time frame of 1 year at a time, we can see that there are 23 years of negative returns, shown here on these red bars pointing downwards, or 27% of the time we had negative years. But we had 93 years of positive returns, or 73% of the time. This is very interesting to me. Look what happens in the second scenario. In the middle, it observes consecutive 5-year time periods. So each bar is a rolling 5 years over the same period. As time period is stretched to increments of 5 years at a time, we observe that there are 8 periods of negative returns down below, and not 23. It also represents 13% of the time as opposed to 27. And please note that there are 82 years of positive returns shown in the green bars, or 87% of the time. But when we expand the time period to show 15 consecutive year time periods, something even more amazing occurs historically. And that is, when we look at time periods for 15 years at a time consecutive, there have been 0 times of negative downturns and 100% of positive returns. Let's take a look at historical account of past downturns and recoveries. Looking at the data this way, we can help present a better picture of potential market performance. We'll observe the downturns in the left column and their durations, how long each downturn lasted, and we'll look at the corresponding recoveries and its duration on the right column. There have been many U.S. equity market downturns over time, as we're seeing here, with varying levels of severity and differing lengths of recovery. The most severe downturn is the Great Depression at the top of the chart here. Stocks lost over 80% of their value. In this case, the recovery period was over 12 years. More recently, stocks lost 44.7% of their value during the early 2000s bear market. The recovery period lasted 4 years. This was the second longest in history. Stocks lost over 50% of their value, as many of you may remember, during the recent 2007 to 2009 bear market. This downturn lasted for 16 months. And the stock market recovered after 37 months in March 2012. It is evident that stocks are prone to sudden declines in value, no doubt. There are many different reasons for stock market crashes in bear markets. Sometimes stocks recover their value quickly, while other times the decline lasts for a while. The recovery period may be painfully long. Often the decline is preceded by a period of high returns, which lulls investors into false sense of security. The last 11 years prior to this downturn has been one of those markets. Because no one can predict market declines with certainty, a diversified portfolio may be the best solution for a long-term investor who is concerned about both the risk and the return. Returns and principles invested in stocks, remember, are not guaranteed, and diversification, although it may help, it will not completely eliminate the risk. This chart is looking over the history of the market as well over a 93-year time period. Over the 93-year time period, there's been 4 times where markets failed to reach returns above 0 for 2 or more consecutive years. So 4 times in history when 2 or more years of negative returns. And we also show in the dark blue the progress immediately after. In all four instances, negative returns have been followed by above average positive returns in this dark blue. This pattern is not guaranteed to repeat itself, but illustrates that market potential and one of the reasons to stay focused on your investment plan. Ceasing regular investments during market downturns can sometimes deprive you of future opportunities. A disciplined investment approach is still one of the best strategies for handling market downturns. This includes maintaining a well-diversified portfolio and using dollar cost averaging instead of lump sum purchases to ease into these investments over time. Finally, staying focused on a long-term investment plan may enable investors to participate in their recoveries. Dollar cost averaging does not ensure a profit or protect against the loss in declining markets, remember, and it may involve continuous investments regardless of the fluctuation in prices. So you need to make sure that you can consider your financial ability to continue these purchases through that time period. We're going to look at diversification here, and if you ever heard the expression, don't put all your eggs in one basket, you may have a good sense of what diversification is. To practice this in the context of investing, diversification means the strategy of holding more than one type of investment, such as stocks, bonds, and cash, in a portfolio to help reduce risk. In this chart, we will display global winners and losers from at the top 2012 to 2020, early 2020. Each row listed here on the left shows a particular investment and is sorted from their 2019's returns, from the highest return to the lowest of 2019. That's how these are sorted. As we look back to 2012 and forward to 2020 here, we see that 2019's top performers weren't necessarily the top performers in all of the years. An investor can diversify among their stock holdings by buying a combination of large, small, and international stocks, and among their bond holdings, they can buy short-term, long-term, governmental bonds, high and low-yield bonds. The diversification strategy helps to reduce the risk because stocks, bonds, and cash, they generally do not react identically in changing economic or market conditions. And it's especially true for assets whose underlying fundamentals, which is the source of their cash flows, differ from other assets in the portfolio. Now let's take a look at four major crises from January 1970 through December 2019, which, by the way, is roughly my timeline. Economies and markets tend to move in cycles, and the stock market can have a downturn once in a while. Most investors lose money when the stock market goes down, of course, but some people may think that they can time the market and gain. For example, an investor may aim to buy in when the market is at its very bottom and cash out when the recovery is complete, thus enjoying the entire upside. The problem with this type of reasoning is that it's impossible. It's impossible to know when the market hits bottom. Most investors panic when the market starts to decline, as I'm sure many of us have in this most recent downturn. But then they decide to wait and end up selling after they have already lost considerable value. I hope none of that was for you on the call today. Or on the recovery side, they buy in after the initial surge in value has passed and they miss most of the upward momentum. The graph illustrates a growth of $1 on the left here, invested in U.S. large stocks at the beginning of 1970, and the four major market declines that subsequently occurred, including the recent banking and credit crisis, listed here. Excuse me. Panic is understandable in times of market turmoil, but investors who flee in such moments may come to regret it. Each crisis, when it happens, feels like it's the worst one ever, much like we're feeling today. When viewed in isolation, on the lower tier graphs, each decline appears disastrous. And if you look closely, hopefully you can see on your screen, $1 value almost gets divided in half in most of these instances, losing half its value. However, historical data shows that holding on through difficult times can pay off in the long run. For example, $1 invested in January 1970 grew to be $153, almost $154 by December 2019, and it generated a 10.6 compounded annual return. In the past, when looking at the big picture, every crisis has been eclipsed by long-term growth. Now, considering the previous slide, let's take a deeper dive into one of these, the recent global financial crisis, which is shown here on this gray bar. The chart illustrates the value of a $100,000 investment in the stock market during the 2007 through 2019 period. It included the global financial crisis and the recovery that follows. The value of the investment dropped from $100,000 if you were in the market to $54,000, almost half its value by February 2009. This is a severe market decline, as you can imagine. Now, investors who attempted to time the market ran the risk of missing periods of exceptional returns, lead to a significant adverse effect on the ending value of the portfolio, which we'll look at here. If an investor remained in the market over the next 10 years, the ending value of the investment would have been almost $300,000, even after losing half of the investment early on. If the same investor exited the market at the bottom, shown here in the dark blue, if they exited the market and stayed in cash for a year, and then they reinvested in the market, the ending value of the investment would be less than $200,000, a $100,000 difference in growth. If you would have stayed, of course, in all cash and never come out, your $54,000 would have grown to $57,000, still compared to its original $100,000. Again, this is interesting historically, and growth is not guaranteed, but it does tell us something here. I want to talk a little bit more about diversification. We all know that stock prices suffered during the financial crisis, but however, a balanced portfolio, it can help mitigate some of this risk. We're going to look at this pie chart up here with an allocation of 40% bonds and 60% stocks. The image illustrates this type of balance after 6 historical U.S. financial crises down here at the bottom, holding this roughly balanced. We're going to look at it through a short term of 1 month, 6 months, and therefore follows through 3 years and 5 years. In the short term, uncertainty from such external shock can create sudden drops in value. For example, the balanced portfolio posted a negative return in the months followed 3 out of the 6 instances, and you can see that in the red bar below. 3 out of the 6 instances, the next month hit a loss. But over longer periods of time, shown here in the dark blue and the light blue, the returns were much more attractive. Investors who stayed the course reaped considerable rewards. Fear and uncertainty may lead investors to sell their investments during tough times, putting downward pressure on their price. Trading because of these emotions can be detrimental to a portfolio's value. By selling during down price pressures, investors might realize short-term losses. Furthermore, this is compounded as investors wait and they hesitate to get back into the market, possibly missing some or all of the potential recovery. The lesson here is that patience may pay dividends. And diversification can also limit losses during turbulent market conditions. One of the main advantages of diversification is reducing risk over the long run, not necessarily increasing returns. While stocks offer potential for higher returns, the downside risk can also be extreme. A diversified portfolio can help mitigate such extreme swings in value, and we will be looking at that next. Governmental bonds are guaranteed by the full faith and credit of the U.S. government as to the timely payments of principal and interest, while returns and principals invested in stocks are not guaranteed, and stocks have been more volatile than bonds over time. One of the main factors you should consider when investing is the amount of risk or volatility or market swings that you were prepared to assume. I think every one of my clients was a risk taker until risk enters the picture, which is recently. However, this chart recognizes that the range of returns appears less volatile with longer holding periods. The graph illustrates a range of common annual stocks, small stocks, large stocks, long-term governmental bonds, and treasury. And we're going to look at their holding period of 1, 5, and 20-year holding periods of each of these through the history of the stock market. On an annualized basis, since the beginning of the stock market, returns in the large stocks, which is highlighted here in light blue, they have ranged from 54% gain to a loss of 43%. But look what happens if our holding period is extended. For longer holding periods, for 5 and 20 years, however, the picture starts to change. The average returns range from 28, maybe 29% gain to a negative of 12.5 here in the 5-year holding period. You can see that the swings are much less. And over a 20-year period, we go from a gain of 17% to a positive gain of 3%. During the worst 20-year holding period for the stocks in the history of the market, stocks have still posted a positive 20-year compounded annual return. However, keep in mind that holding stocks for the long term does not ensure a profitable outcome, and that investing in stocks always, of course, involves risk. Although stockholders can expect more short-term volatility, the risk of holding stocks appears to lessen with time. Over the long term, periods of high returns tend to offset periods of low returns. With the passage of time, these offsetting periods result in the dispersion of returns gravitating or converging towards the average, which you can see the white line. In other words, while returns may fluctuate wildly from year to year, holding the asset for longer periods of time results in apparent decrease in volatility. And remember, it's easy to follow a long-term strategy during the good times, like the last 11 years. The hard part, of course, is sticking with it through the bad times. What should you do if you're a long-term investor sitting in the midst of a bear market? If you are holding a well-diversified portfolio, the answer is simple. Continue to stay the course. The image illustrates the hypothetical growth of stocks, bonds, and an equally diversified portfolio over short and long-term periods. The graph here on the left, it illustrates the performance of the assets. Again, stocks in the dark blue, a balanced portfolio of stocks and bonds in the gray, and bonds only in the orange. And this is one of the worst 3-year time periods in recent history. As illustrated, the significance of holding a diversified portfolio is most apparent in the bull bear market here, a downturn. Although the diversified portfolio still lost more, right here, lost more than the bonds in the short run, it did not withstand a great loss as the stocks only. Over the long term, however, which we'll look at next, the picture begins to change over here on the right. The graph on the right illustrates the performance of these same assets over the long run, from the beginning of 1975 to year-end 2019, just recently. By continuing to hold the all-stock portfolio past 1975, after this downturn here, one would have experienced the highest ending wealth value of assets shown. However, it is important to understand that in order to achieve this greater wealth, it was achieved by considerable volatility in the downturn. It's indicated over here on the left. While more volatile single asset is likely to outperform the less volatile diversification portfolio over the long run, the main point to understand is that maintaining a well-diversified portfolio, you are managing risk, not trying to escape it. Again, you are managing risk but not escaping risk. I wanted to show you this past historical declines and positive return shortly following to maybe put today's downturn in perspective. Most of us, not all, most of us, the last decade or so has been a big percentage of our investment period. And that period has looked very rosy. Sometimes it's hard to go back in history to see if there's been other times other than this and what has occurred before, during, and after. I didn't want to take up too much of your time today, but I do hope that it was valuable. We hope that today's look into the past will help understand how today's market decline may compare to historic declines and recoveries, and how different investment time horizons as well as diversification may impact the outcomes. As we discussed earlier, each investor may have different objectives, different resources, different timelines, and risk tolerance. Not any one strategy or investment would be appropriate for everyone. In addition, there are many savings and investment vehicles available to store your future lifestyle dollars in. Each has a unique set of costs and benefits. One must also consider taxation, which we did not discuss today, as well as accessibility, which we did not discuss. And please remember, although we studied a lot of past performance, it does not guarantee going forward. Concepts that we've covered today, such as investment time horizon, diversification, dollar cost averaging, and others, that does not eliminate risk entirely. Again, thank you so much for attending. If you're interested in a more personalized discussion, or you would simply like answers to specific questions, please include your email in the chat section over there on the right, and we'll give you a call or an email for a personal conversation. Or you can reach out to my Vice President, Jason Lee, for any type of meeting that you'd like to set. I'll be happy to visit with you about current situations, the COVID-19 impact, as well as others. We appreciate your time, and we look forward to hearing from you. Thank you very much.